Guppy Multiple Moving Average provides an interesting alternative to other popular indicators. The GMMA implements two different exponential moving averages in an effort to analyze market behavior on multiple levels. The Guppy indicator is composed of 12 EMAs, so essentially the Guppy and the EMA are the same thing. Guppy will help you to isolate trends, spot opportunities and warn about price reversals. The multiple lines of the Guppy will help you to see the strength or weakness in a trend better than if only using one or two EMAs. The GMMA is an indicator that tracks the activity of two major groups in the market. These are investors and traders. Traders are always probing for a change in the trend. In a downtrend, they will take a trade in anticipation of a new uptrend developing. If it doesn't develop, then they get out of the trade quickly. If the trend does change, then they stay with the trade, but continue to use a short-term management approach. No matter how long the uptrend remains in place, the trader is always alert for a potential trend change. Often, they use a volatility-based indicator or a short-term 10-day moving average to help identify the exit conditions. We track their activity by using a group of short-term moving averages. These are 3, 5, 8, 10, 12, and 15-day exponentially calculated moving averages. Strong trends are supported by long-term investors. These are the true gamblers in the market because they tend to have a great deal of faith in their analysis. The investor takes more time to recognize the change in a trend. We track the investor's activity by using the 30, 35, 40, 45, 50, and 60-day exponential moving averages. So the GMMA attempts to identify trends by combining two groups of moving averages with different time periods. The longer-term EMAs represent the interest and behaviors of investors that have taken a long-term approach to a given market. The short-term EMAs represent traders or speculators who are attempting to capture short-term profits. The relationship within each of these groups tells us where there is agreement on value, when they are close together, and when there is disagreement on value, when the moving averages are well spaced apart. The relationship between the two groups tells the trader about this trend on the market action. A change in price direction that is well supported by short and long-term investors signals a strong trading opportunity. Guppy is an easy indicator that will allow anyone to determine the overall trend of the market quickly and without personal bias. And of course, once you know the general direction of a trending market, the odds of a successful trade increase. The GMMA also offers insight into potential reversals or periods of consolidation by signaling changes in market sentiment. Although Guppy is a standalone trading strategy, I have found great results combining Guppy with price action, but we'll talk about this later. So how to read the GMMA? The Guppy Multiple Moving Average can be used to identify changes in trends or determine the strength of the current trend. The degree of separation between the short-term and long-term moving averages can be used as an indicator of trend strength. If there's a wide separation, then the prevailing trend is strong. Narrow separation or lines that are crisscrossing indicates a weakening trend or a period of consolidation. The crossover of the short and longer-term moving averages represent trend reversals. If the short-term crosses above the long-term moving averages, then a bullish reversal has occurred. If the short-term moving averages cross below the longer-term ones, a bearish reversal is occurring. When both groups of moving averages are moving horizontally or mostly moving sideways and heavily intersected, it means the asset lacks a price trend and therefore may not be a good candidate for trend trades. These periods may be good for range trading. The indicator can also be used for trade signals. When the short-term group passes above the longer-term group of EMAs, the market is bullish. When the short-term group passes below the longer-term group, the market is bearish. These signals should be avoided when the price and the EMAs are moving sideways, following a consolidation period. Pay attention at crossovers and separation. When the lines start to separate, this often means a breakout from consolidation has occurred and a new trend could be underway. During a strong uptrend, when the short-term moving averages move back toward the long-term moving averages but don't cross, and then start to move back to the upside, this is another opportunity to enter into long trades in the trending direction. The same concept applies to downtrends for entering short trades. The green moving averages represent short-term traders and red represents long-term traders. When both the red and green lines are moving in agreement, both trending up or down, we are given a confirmation of market sentiment and trend. The moving averages may also act as support or resistance. When price finds support at these levels, it might be a good time to add positions if you see further upside potential or you have spare risk capital available. When price tests the red moving average zone, long-term traders will look to buy more given their outlook is still bullish. The strength of the trend is determined by the distance between the red and the green moving average clusters. The further the distance, the greater the trend. Another way to evaluate the strength of a trend is to evaluate the spread between each moving average cluster. If the longer-term red averages are spread out nicely, this indicates that the support or resistance level is broad and strong. If the lines within the cluster are narrowing, this indicates momentum is declining and the reversal or consolidation could follow. Just like simple moving averages, you can use crossovers as entry and exit signals. When the short-term moving average cluster crosses above the longer term, this signals a change in market sentiment and suggests that short-term traders are starting a new trend. For instance, this Guppy crossover indicates that short-term traders have become optimistic about this asset and could potentially start a new bullish trend. The strength of the trend is determined by the distance between the red and the green moving average clusters. Like I said before, the further the distance, the greater the trend. Now, if you followed my previous videos on moving averages, you probably know that I'm not the biggest fan of moving average crossovers. Since the GMMA indicator was designed for trending assets, these moving averages run into problems when price consolidates. The indicator shows consolidation and potential reversals when the short and the longer-term moving average condense. The main limitation of the Guppy indicator is the lagging factor. Each EMA represents the average price from the past. It does not predict the future. Waiting for the averages to cross can at times mean an entry or exit that is far too late, as the price has already moved aggressively. All moving averages are also prone to whipsaws. This is when there is a crossover, potentially resulting in a trade, but the price doesn't move as expected, and then the average crosses again, resulting in a loss. So in times of consolidation with multiple crossovers, I find it very useful to combine price action with GMMA. You could also use the Guppy multiple moving average in conjunction with other technical indicators to maximize your trading odds. For example, you might look at the relative strength index to confirm a trend, or look at various chart patterns to determine other entry or exit points after a GMMA crossover. From my experience, the GMMA is very useful for breakout trading, when the price is moving outside a defined support or resistance level with increased volume. A breakout trader enters a long position after the price breaks above resistance, or enters a short position after the price breaks below support. The reason breakouts are such an important trading strategy is because these setups are the starting point for future volatility increases, large price swings, and in many circumstances, major price trends. Breakouts occur in all types of market environments. Typically, the most explosive price movements are a result of a channel breakout or a price pattern breakout. So when there's a lot of separation between the GMMAs, this helps confirm the price trend in the current direction. Look for agreement between the short-term and the longer-term moving averages and pay attention to chart formations such as channels, triangles, and flags. Whether you use intraday, daily, or weekly charts, the concepts are universal. You can apply this strategy to day trading, swing trading, or any style of trading. Once you spot a clear trade setup in your desired time frame, remember to set the stop loss just above or below the short-term moving averages. Or if you want more room, decrease your lot sizes and place it below or above the longer-term moving averages. Although a simple indicator, the GMMA can offer valuable insight to any momentum or swing trader. Guppy is a standalone trading strategy. However, I have found the greatest returns when combining Guppy with price action, because price action addresses periods of consolidation where Guppy tends to underperform. So always try to maximize your chances of a great trade by confirming your bias with other tools. If you learned something new and found value, leave us a like to show your support, and don't forget to subscribe and hit the bell icon to stay in touch with new uploads. Until next time.